So, can the government really control the economy? For a long time, it sure seemed like the answer was yes. Economists thought they had this reliable menu of options, a way to kind of dial unemployment up or down. But then, one single paper in 1973 changed absolutely everything. Today, we're going to dive into Robert Lucas's groundbreaking work that just shattered the very foundations of macroeconomic policy.
Okay, imagine you're at a restaurant, right? And the menu has this special deal. You can get a really delicious dessert, but the catch is you also have to accept a side of, I don't know, steamed broccoli. That's kind of how policymakers saw the economy back then. They thought they could buy lower unemployment, that's the dessert, by just accepting a little more inflation, the broccoli. It seemed like a simple, totally predictable trade-off.
But then Lucas comes along and throws this huge wrench in the works. He asks this simple but totally devastating question. What if the menu changes every single time you order? What if, by constantly choosing the dessert, you actually make the broccoli taste worse and worse until the whole deal just isn't worth it anymore? That right there is the essence of his critique. The very act of trying to use the trade-off makes it vanish.
To really get why Lucas's work was such a big deal, we got to go back to that old way of thinking. At the heart of it all was this beautifully simple, almost elegant idea that for years seemed to just perfectly explain how the whole economy worked. This was the famous Phillips curve. It basically suggested a clear, stable trade-off. A little more inflation gets you a little less unemployment. And for policymakers, wow, this was like a magic lever they could pull to steer the economy exactly where they wanted it to go.
But, not everyone was buying it. Some economists, like Milton Friedman and Edmund Phelps, were already a bit skeptical. And then came Robert Lucas, who didn't just question the Phillips curve, he took a metaphorical stick of dynamite to it. He argued that this supposed trade-off wasn't some permanent feature of the economy at all.
Lucas's counterargument was something called the natural rate hypothesis. Think of it like a rubber band. You can stretch it for a little while, sure, you get a temporary boost, but it always snaps back to its original shape. Lucas argued the economy is the exact same. You might get a short-term kick from some surprise inflation, but in the long run, you're always going to end up right back at that natural rate of unemployment. So how did he do it? How did Lucas actually prove his point? Well, he built a brand new model of the economy, and at its core were two massive ideas: rational expectations and imperfect information. In simple terms, he assumed that people are smart. They use all the information they have to make decisions. But, and this is absolutely critical, he also recognized that they don't know everything. Now, to make these ideas really click, Lucas came up with this brilliant thought experiment. Imagine the entire economy is like a series of isolated islands. And on each island, there's a supplier who can only see the price of their own product. They're just trying to make a living, but they have a very, very limited view of the world. So, here's the puzzle. One day, our supplier on the island sees the price of their product go up. What on earth does that mean? Is it a real signal that demand for their specific product is surging and they should start working overtime? Or is it just noise, a sign of general inflation that's hitting the whole economy? This is what he called the signal extraction problem. The stakes are pretty high here, right? If demand for their thing is really up, they should definitely work harder. But if it's just inflation, working harder is a total waste of their time and energy. So what do? Well, they've got to make an educated guess. And that guess is based on their past experience with how the economy has been behaving. And this is where the genius of the model really shines. In a stable economy, like the US was in the 1960s, a price jump is a pretty big deal. It's unusual. So the supplier is likely to think, hey, this must be real, and they ramp up production. But in a place like Argentina back then, where inflation was just rampant, a price jump is, well, just another Tuesday. The supplier will probably just shrug and assume it's more inflation and carry on as usual. So this simple model makes a really powerful prediction. That Phillips curve trade-off, it should be strong and obvious in stable economies, but really weak or maybe totally non-existent in volatile ones. So Lucas did what any good economist does. He went to the data from 18 different countries to see if his theory actually held up. And the results were absolutely stunning. Just look at the difference here between the US and Argentina. The Argentinian economy was way, way more volatile, and because of that, the trade-off between inflation and output, that number pi there, was almost zero. It was basically gone. This chart just says it all, doesn't it? In the US, a little bit of unexpected inflation could buy you a whole lot of real economic growth. The lever worked. But in Argentina, that same inflationary shock bought you, well, basically nothing. It all just turned into more inflation. The trade-off had completely vanished into thin air. As Lucas himself put it, In these really volatile economies, people see through the government's tricks. They've learned from experience that a sudden price increase is almost certainly just a sign of more inflation, so they don't change their real behavior one little bit.
So you can imagine this was a bombshell for policymakers. It meant that the Phillips curve wasn't some fixed law of nature that they could always count on. It was a moving target. And here's the real killer. The government's own actions were causing it to shift.
So, what happens when a government finds that magic lever and decides to just pull it over and over and over again? You're back in the 1960s US and you've got this great tool. You pull it once. Hey, you get a nice economic boost. So you pull it again and again. What do you think happens? Well, people catch on. They're not robots. They learn the government's game. And once they do, the game is over. They start to treat all those price signals as noise, not news. The trade-off just disappears. And that, in a nutshell, is the Lucas critique. The very act of trying to exploit a relationship in the economy can cause that relationship to completely break down.
Lucas's paper wasn't just another study. No, this was an absolute earthquake for macroeconomics. It forced economists to go all the way back to the drawing board and rethink pretty much everything they thought they knew about how the economy works and how policy should be made. The big takeaway from Lucas is that the economy isn't some simple machine that you can just tinker with. It's a complex, dynamic system full of people who are constantly learning, adapting, and trying to anticipate what's coming next. And if you want to make good policy, you absolutely, positively have to take that into account. So if the old, simple menu is gone, if the rulebook has been torn up, what's left? How can governments possibly manage the economy in a world where people are smart and forward-looking? That is the profound, massive question that Lucas left us with, and it's one that economists and policymakers are still wrestling with today.